Welcome back to HFO Multifamily Market Watch, your trusted source for information for apartment owners and investors. Multifamily Market Watch is presented by Pacific Exteriors Northwest, a contractor specializing in siding and exterior envelopes and delivering exceptional quality and service for over 30 years. And by Gantry Incorporated, the nation's largest independent mortgage banking firm.
Welcome back to Multifamily Market Watch. I'm Greg Frick, partner with HFO Investment Real Estate. And today we have with us back again, Charlie Kokernak with Gantry. Good to see you again. It's great always to get your perspective on the market and where we are with, this ever-changing financing world. So again, thanks for taking the time to do this. Maybe talk a little bit about, we had you speak at our event in January. A lot of things have changed. Some things are the same. Mm-hmm. What's happened in the first quarter? How would you, we're almost at the end of March here. What would you say, how would you encompass what happened in the first quarter of 2025 from the financing side, from your perspective?
Sure. Well, it definitely feels like we've moved somewhat into our news cycle. Yeah. And there's no groundhog that stuck its head up out of the hole and said, okay, it's winter or spring. But the transactions that are coming across our desk, some of them feel somewhat older vintage, whether it's the level of leverage people are looking for, or the way that a deal is structured or capitalized, or sometimes unrealistic expectations for leverage. But then that said, there are new transactions with strong requests, realistic expectations in underwriting and how the capital stack is structured.
Which was different than the fourth quarter of 24.
Absolutely.
Yeah. Okay.
Yeah.
So that's good. That's a positive from that standpoint.
Yeah. And, last year really was the beginning of, halfway through the year in 24, we found ourselves in somewhat of a stagnating rate period. At the end of the year, rates were dropping, but there still was uncertainty with the election. At this point, the last 2 months have politically been the longest, decade of our life.
Yes,
but we have
uncertainty,
further clarity than we did 6 months ago,
right?
In where at least the market's headed. Some markets, for better or worse, are perceptively hitting bottom and or making that turn back towards a rise, which is absolutely good news.
Yeah, I think I tell people in 24, really, especially the second half, there was this, I'm going to wait and see.
Right.
I'm going to wait and see what's going to happen. I'm going to wait for after the election. We're going to think, and then I think it almost feels like now it may not be the news you exactly wanted, but at least you can say this is kind of the new, this is the baseline we're going to go off of and start making decisions.
Yeah, absolutely accurate.
Yeah. So what kind of, what are you seeing on the deal flow? Is it a particular, product type? Is it everything that's kind of percolating up, or new projects? Kind of shine some light on that.
Yeah, well, there's been a lot of pent-up demand on the equity side.
Right.
People have wanted to go out and reinvest. If there are the 3 or so normal reasons why somebody would sell a property, whether it's somebody in the family passed, or there's a dissolution of the partnership, or, I split up with my significant other, we have to sell the asset. I think we can add 3, or I should say 2 other Ds to that list, which is default. I have this maturity coming up. I need to sell.
I need to do something.
I'm willing to move on, or depreciation. I have no tax shelter anymore. I need to sell this because I need to get out of, this huge tax bill that I need to pay. And so while you have that organic, I do want to go invest in the market, you have somewhat of the inorganic. I have had 2 or 3 years of pent up demand on the equity side. And while that capital is certainly available, that dry powder, so to speak, it's not making, dumb investments. There's still very clear underwriting guidelines in place that equity is expecting, and that, debt is seeing too, which is, further good news. Underwriting standards have been held consistent
throughout. Yeah. Something I've been telling people is I think we're going to see an increase in transactions in 25, but that doesn't necessarily equate to we're going to see a huge run up in pricing. It's almost as if the equity that's getting out, or sellers are getting out, have kind of recognized this is where we are, and if they're going to have to make this move, they're making the move. It's, like you said, there's been up capital, but it's capital that's not making this far-reaching decision to go above and beyond. Maybe there's a little bit of stretch, but it's more as if the sellings have kind of capitulated on pricing, and that's why I think we'll see some been-up demand from the capital getting in, but they're not making crazy reaches, so to speak.
Right. Yeah. And some of those reaches, we always talk about what is the alternative if you're going for conventional financing. Some people are going and they're just stroking a check for the building. I'm going to buy it all cash. Can I get seller carry? Maybe it's more of a generational asset where the seller didn't have debt on it. Those seller carry notes at some point will need to be dealt with. Yeah. But people are taking advantage of what is perceptively a very, very good basis.
And is that, you think, people doing that, and then with the idea, hey, I'm going to call you, Charlie, once I'm going to get it closed, get it done, do whatever I need to do, the operations, and then we're going to be coming at the table. Hopefully we get some benefit in rates, but if we don't, we know where we are and go from there.
Correct.
Yeah.
We really kind of we're finding our new market footing. if last year was the recalibration and this is the footing, okay, this is the new base for this or that vintage of property or this or that location, whether it's CBD or something that's more suburban, we're now figuring out what that new normal is.
Right. Mm-hmm. And then for you, because I know you represent a lot of life companies, lenders, what's the take on capital, their take on, we have this perception we've been trying to get over. I mean, what's their take on having, exposure in this market?
Well, it's a great basis for many. Okay. I mean, the fact is Portland in this last cycle, or maybe I can't say last cycle, the cycle before this last one was a value play. People could come in and get a slightly higher cap rate. There was a tremendous amount of rent growth. Mm-hmm. We have seen rents, stagnating, some concessions. I expect, in kind of a different conversation in itself, that those concessions will start to drop off once this stock we've seen that has been delivered gets absorbed in.
With nothing behind it.
With
there's no
nothing behind
it at all.
Nothing behind it. But, one thing to remember, if we're just talking locally, lenders love the fact that we have an urban growth boundary.
Right.
As challenging it is, to make something build in that next ring, it keeps land value high because everything effectively is infill.
Right. Which, and then again, with that, if the economics don't work on the new construction, puts more pressure on the existing, which from a return standpoint,
exactly,
as we see. So, which is good to hear. So there is some positive news coming out of the region in terms of how we're looked at nationally.
Absolutely.
What are the big challenges you see on deals you're looking at now that are coming into your queue? Is it operations? Is it 24 expenses? I mean, what are the things you're kind of keeping you up at night of like how we're going to get this thing through?
Sure. Well, I think first and foremost, 9 out of 10 loan requests are all income restricted.
Okay.
It's not going to be your loan to value maximum unless you're buying something at a 7 cap. And sometimes that 7 cap is coming with a story. But it's going to be, okay, how does the lender get to a 120 or a 125 or sometimes a lower debt service coverage constraint? But, given the fact that caps really didn't expand as quickly as interest rates did, and certainly not to the same extent, right, most deals are limited to about 65% of value.
So it's the proceeds.
Right. Yeah. And then one other, as you mentioned, the operations, lenders are questioning, they were questioning more during COVID, what tenants aren't paying rent. Did the tenancy kind of link arms and decide, I guess we're just not going to be paying for housing anymore?
Right.
That conversation is no longer front and center.
Okay.
However, there is question about, you're buying this property. Do you have an active quote for your new insurance load?
Right.
And newer vintage projects, it's less of a challenging question than older ones. But insurance is constantly coming front and center as far as a topic of conversation. If, for instance, your rents are stagnating, or you might even be seeing some concessions, if your expenses are growing faster than your income is, at least for a short period of time,
that's a trouble. That's a problem.
Yes. And rents will eventually catch up, of course. But it's something that is a big topic of conversation when we're looking at all new requests, is how real is that underwriting?
And then which is interesting on insurance. I know I've heard it a little bit on the single family side of changing kind of the requirements from the lending side for insurance. Do you see that coming into the commercial side in terms of the cost of these policies? Do we, is the limit of the replacement cost? Is it, limiting maybe some of the, type of claims you can make? I mean, is there a sense of that coming, or where do you see that?
Yeah. So on top of just being a capital markets intermediary, we have about a $23 billion servicing portfolio at Gantry. A lot of life insurance company loans, all of which we close. Some CMBS, some of the agency loans as well. We actually brought an insurance expert on staff a couple of years ago because this kept on being such a prevalent item. We're actually ongoing right now a review of the entire portfolio to understand how much of an increase incurred in different property types in different sectors of the country, just so we can go back and speak with our lender partners, because, for many of these groups, we are their eyes and ears in the market, and show them your requirements in this or that aspect, either asset type or location, sometimes are creating an undue stress on the property's operations. Lenders don't ever want to have to put a requirement for insurance that causes the property not to operate as well.
And again, 10, 20 years ago, when that policy was put in place, it wasn't an issue. This cost wasn't an issue. It was an incremental increase for maybe some of these added benefits on the policy. Now, when's the last time they probably dug into those? It's probably been years.
You're absolutely right. Well, it's that, plus you have less insurance providers in markets.
Yes.
You look at California, State Farm pulled out of many of those policies. And the reality is, they are taking a bet, and they were somewhat right. They didn't see the fact that their premiums were balanced with the potential risk of some large event like those fires occurring. And while that's just brutal to say, is that California as a market didn't create a market where an insurance provider could balance their risk proportionately. And so when you have a large provider leave, as far as the supply and the demand of active policies, you have less people providing, and they don't have to be as competitive.
Right. Well, so it'll be very interesting once you guys go through this, is the feedback you get from that industry of, on the lending side, do we need to make some tweaks on what the expectation on the level of coverage is?
Exactly.
Because again, if we continue the same pattern, it's going to be unsustainable on some of these increases. Not that I expect the same kind of, it's almost like we did a catch up the last couple of years. The question now is moving forward, what does that look like?
Right.
What other kind of on the expense side are, is how are they dealing with, as we've seen concessions we kind of talk about. We talked about bad, delinquents. What I've seen is the numbers are not as great in the number, that we have some tenants that have learned how to work the system a little bit, and we've got bigger balances. How does a lender look at that as we, come like to the end of the year? They want to just get it off the books, as the borrower does. What's a good way for a borrower to kind of, is there put the story behind it, to look at a lender and say, hey, look, we had a lot of collections. What's a good way for them to deal with that?
Well, and maybe to directly answer your question, if we see a tenant who hasn't paid rent in 3 or 4 years, and they're just hiding behind their attorney, and it's an $80,000 balance, we're probably just not going to underwrite the income from that unit
at all. Okay.
So pretend like that's not there. The reality, though, is unfortunately the income expense load is still there.
Right.
And so that is a painful point where the system we have created, inherently does overly protect some aspects of this. But the reality is, if we had more stock that was continually delivered that kept a natural and organic turnover, that may not be there. But this is, the hopes and dreams versus the reality of the market that we do have.
Are they able to look at that if it's something that was addressed in 24, then projecting forward? Okay, this was addressed. We're not okay.
Yeah, absolutely. If it's this historical operation was lower than hopeful, and now this tenant is gone, and we have a new tenant at market, the unit's been renovated. Absolutely, lenders will be able to underwrite that new income going forward.
Okay.
Yeah.
So for your clientele, or for, same clientele, is what do you, if somebody comes in, I want to talk about, they're always asked, what do you think rates are going to do? And I always say, if we knew what rates were going to do, we probably wouldn't be sitting here.
Right.
What are you seeing? Has there been a change in the kind of, I know loan to value, the proceeds are lower. Are there any other, is it, adjustable prepays? Is it, I want flexibility because I think something's going to happen in a couple of years? What are you seeing on the product delivery of what people are asking for?
Sure. Well, I think you can have a, borrower field fall into a few camps. One is those that are longer tenured in the industry realize that rates, while historically higher than we'd like, they're
historically still pretty competitive.
Yeah, actually, I should rephrase that. Generationally higher than we'd like.
Yes.
Historically, they're very average.
Right.
So in the last 6 months or so, when rates dipped towards the end of 24, we did have some more generational holders lock upwards of 15 years fixed.
Interesting.
In the mid 5 range.
Okay.
That said, the opposite side of that kind of spectrum of, the owner field of the groups who might have needed 85% leverage. I need to have every dollar or this deal doesn't work. Unfortunately, the market shook them out first and foremost, kind of separating that wheat from the chaff.
And that deal probably still doesn't work today.
Probably doesn't work today.
Right.
But, on a go-forward basis, we have seen the lender field come to the call to have flexibility.
Okay.
Whether that's having, 3 or a 5 year. I would frankly never recommend a 3-year term because you blink and a few years go by. But having it maybe a 5 or a 7-year term with some sort of flex prepay is there. Some are happy to give that sort of flexibility with a de minimis increase in cost. There are some programs too that have floating rates that can either be fixed or can be paid off should rates shift around.
So flexibility with the floating rate, depending on what rates do in the future.
Correct.
You've got some flexibility to do something.
Correct. But the reality is most of the lending market we're seeing today is extremely competitive. We're filming this in mid-March.
Right.
And right now we are seeing the tightest spreads for multifamily than I can remember for the last at least 3 or 4 years, not counting that small period right after COVID started where things got really wonky. Lenders are competing for the business they want.
So this is dollars that are trying to get out. They're trying to get competitive to get out there again.
Yeah. We represent about 45 life insurance companies, as you know, some of whom we represent exclusively in various markets, one of which is extremely competitive. So competitive so that of their allocation of dollars that they want to get out the door for 25, they are already out.
Wow. Really? Okay.
In mid-March.
Wow.
And that's not because they have a small allocation. We're talking hundreds and hundreds of millions of dollars. It's because of the deals they want to win. The pricing is so competitive that groups are just clamoring for this. They can't get the money out the door fast enough. But what it does mean is the second the bottom of that market leaves, it's not that the rest of the market is going to be undesirable, but that might move spreads up by 5 or 10 basis points because their competition realizes we don't necessarily need to come in and push as hard. Maybe it's a 130 or 140, not a 120 spread. But the fact is right now, mid-March 25, we're seeing the tightest spreads that we've seen in quite a while. Cap rates have somewhat moved out. Hopefully sellers are getting a little bit more realistic about if I want to sell, this could be a great time. And so that's helping us push a little bit more in leverage. Maybe that's a little bit less equity that needs to be raised. This is a great time.
Oh, that's it. Yeah. So is your expectation we'll see deal flow increase this year and continue? Again, I don't think it's going to rocket to where we were in 21, 22,
Sure.
but I think we'll see some incremental increases in terms of deal flow in all product types.
Yeah.
Office excluded. Who knows what we're going to do with office, but interesting. So now we settle people saying the last interview we had is when we say deal flow increase doesn't necessarily mean we're going to see pricing increase in terms of the overall price, the asset. I think you'll see some, sellers kind of meeting the market, and there's some bent up capital now with the lender side getting aggressive. We'll have more, I guess, meeting in the middle, so to speak.
Definitely more momentum for sure.
Yeah.
We're back to, and while we do not represent the market, we are not seeing every single deal.
Right.
Back in 22, I think it was, we had about $5 billion of loan placements. We worked with about 155 or so different capital sources, credit unions, life insurance companies, agencies, so on and so forth. In 23, that dropped off to 86.
Okay.
Last year, we were back to 97. So the amount of groups that we are placing funds for on various property types has definitely increased. But last year, we were right around to the same volume level as far as funds placed, right around $3 billion, and right around the same amount of lenders as 2019.
Interesting.
So it's been somewhat of a reset of a half decade or so. But I mean, this is a cyclical industry. It goes up, it goes down.
Yep.
If anything, hopefully real estate has just uniquely gone through its own winter, its own recession, while the rest of the economy has just kept pushing forward. And ironically so, dropping rates for the rest of the economy could be what really buoy and boost activity.
Right.
Yeah.
Yeah. To a point, we don't want to see the economy go to, but like I've said, I felt like we've kind of been in a little bit of a recession for the last couple of years, just in terms of deal flow and things like that, where the rest of the economy was continuing to push. Now it's a sense that everybody's kind of feeling a little bit of the pain, just a degree of how bad it is. And maybe we do get some rate relief too. Right. So.
Yeah. Obviously, kind of be careful what you wish for. As you said, you want rates to go down a bit, but not so much that it is going down because we have larger economic uncertainty.
Exactly. Well, I want to thank you for taking the time to come visit again. We'll have you back again. And it's always insightful to see what you're seeing on a, kind of a quarter by quarter basis, because again, it's a very dynamic market and changing all the time, especially with, the last 90 days have been quite interesting. So
absolutely. Yeah. Well, thank you very much for having me.
Always. And we'll see you again next time on Multifamily Market Watch. Thank you.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information. HFO is a member of Global Real Estate Advisors. Learn more at grea.com.